How does it work if I buy a subject to deal? Can I use cost segregation with it? And now we became the bank for them.
Yes.
But we're still responsible for that underlying mortgage every single month. So my question is, I would pay taxes on the amount that I'm getting every single month from them.
So you'd have two pieces. Each payment would be
How do I pay zero tax?
legally or?
How many people ask you about subject to questions right now?
Not a lot, but it's a growing question. So it's coming up more than it has in the past.
Yeah, and so I think what's really fun is that in this episode, Alex and Angel interview you or ask you all of these subject to questions. They're currently, they have 60 deals that they're trying to disposition right now.
Wow.
So Derek is now answering all of those questions. What happens when you do all these subject to deals tax-wise? That's all coming up next.
So my name's Alex. We are buying houses all over the country. We primarily like to buy houses subject to and seller finance. And what we're doing is we are owner financing other people.
All right. So do you have any tax questions for me today?
Absolutely. So my first question would be, how does it work if I buy a subject to deal? Can I use cost segregation with it?
You can, yes. So if you purchase a property, then it's your property, so you can depreciate that. So it will be, the cost segregation would be available to you if you're keeping it to rent out. If you're going to resell it, then it doesn't make much sense to do a cost segregation because it will no longer be your property after you sell it. So that won't necessarily help you out.
And how does cost segregation work?
So cost segregation, they'll take the property. So normally when you buy a property, you just depreciate that property or the building piece by 27 and a half or 39 years. When you do a cost segregation, they're going to separate all the separate parts of the house. And many of those pieces are going to have a shorter lifespan than 27 and a half or 39 years. And so you can either depreciate them faster or use bonus depreciation, which is currently 2024 right now, as we speak right now, it's 60%. But there's a new bill in Congress right now that is projected to pass that will bring back the 100% bonus depreciation. So say you buy, say a $500,000 property, just for simplicity's sake, say 400,000 of that is the building itself. That would be, normally you just divide that by 27 and a half years if it's residential and take that over the life of the property and you get that deduction each year. But say you can carve out 100,000 of that as, these properties, these pieces that are less than, the equipment and things like that are part of the property, then you could get, say, $100,000 immediate deduction if you get the full 100% bonus depreciation that first year that you buy it. So it works well with, like, say, short-term rentals. If you can qualify for that short-term rental loophole where it becomes a business, then you can deduct that against your W-2 income. Or if you do have a high amount of income in the property, then you can use that, that big deduction against the income in the property.
And my next question would be, if I'm assigning subject to deals, do you have to pay capital gains on that?
Yeah, so you're basically, I guess my question would be then, what are the mechanics of that? Are you actually selling the property to the next person?
So we would acquire it under our LLC and then transfer the ownership to someone else.
Yes, yeah, so then basically that would be a sale of the property. Now, if you're doing one or two a year, it would be, probably a capital gain, but if you're doing, multiple a year, then it starts to become a business. And then the IRS will pull that in as more earned income versus capital gains. So, say you're just a single individual and you find one every once in a while and you're just flipping them over, then that would definitely be a capital gain. But if you're starting to do it more and more and, say you do 5, 6, 7, 8 a year, then that becomes a business and not necessarily capital gains. It would actually be earned income on those.
Got it. And another question I have, so if we're doing a wraparound mortgage and we acquire the property and we sell it to somebody else, we have to pay capital gains on that difference. Is that correct?
Are you writing the mortgage to the new owner or are you?
Yeah, so we would be acquiring it subject to the existing loan and then wrapping it to another end buyer that doesn't qualify the traditional way.
Okay, so yes, you still have that gain piece. That would be income. Now, if it's an installment sale, then you just recognize the gain on the payments that you receive. So it wouldn't necessarily be a one big, hit. So say you buy it for 500, turn around and sell for 7. That 200,000 will be spread out over the life of those payments, and then you'd have an interest piece too that you're earning.
Okay, that makes sense.
Yeah.
And then my other question is, what can I write off as a real estate investor?
As a real estate investor, That one's hard because if you're just kind of out there looking at things and not really doing anything, there's not a whole lot you can do because you don't really have a business technically, right? But if you're out there looking at things and actually buying things or, going through the process and, if something happens, you don't actually get it, but you're actually going through the process and working on things, then you can deduct pretty much all the expenses relating to that. But again, you'd have to have income in order to deduct these expenses unless, I guess depending on the type of business, right? So if you're just renting out properties, it's a passive activity and a lot of those losses may not be deductible against other income. But if you have an active business, like say you are doing these, the subject to deals and it is considered a business, then all those deductions can be offset against your income. And if it creates losses, you can take that against, say, other W-2 income.
So we acquire it subject to the existing loan. So now we became the new owner. And now that we're the owner, we can owner finance someone else.
Yes.
And now we became the bank for them.
Yes.
But we're still responsible for that underlying mortgage every single month. So my question is, I would pay taxes on the amount that I'm getting every single month from them.
So you'd have two pieces. Each payment would be principal, and then another part would be interest. And so the principal, you would apply your gain percentage. So say they paid you $100 each month, and in your instance, you sold it for $400, or you bought it for $400, sold it for $420. Your $20,000 gain is about, I don't know, what's that, 5% of your total sales price roughly? So then 5% of every principal payment you receive will be taxable income to you, and then all of the interest, because that's just straight income. And then you can deduct the interest you're paying on that subject to mortgage as interest that because you're paying that interest to finance this whole deal, right? So you'll have your portion of the principal that's income, the interest income, and you'll deduct the interest and then other expenses that you have for the transaction against that.
Great. That pretty much answered the next question I was going to ask. Because I was about to ask, so if we're paying interest on the first lien and the homestead buyer's paying the interest on the pretty much the second mortgage that we created, the first lien, the interest that we pay on is pretty much tax deductible, and we would just get taxed on the interest that the homestead buyer's paying us.
So really you just pay the difference in what you're charging the new buyer against what you're paying on the existing loan. So
okay.
So yeah, basically, right. You claim the interest income that they're paying you and deducting the interest that you're paying. So whatever that spread is going to end up being your net income on that.
And then my other question is, how do I pay zero tax?
Legally or? Plenty of ways to do it illegally.
Well, legally, of course.
Legally, yeah.
You just have to buy a certain amount of properties and then use cost segregation?
Yeah, so again, it would have to be a specific, so you can't just cost segregate anything and take that income, that deduction against it, right? So if it's a long-term rental, then you're limited to the passive loss rules. You only get to take up to $25,000 if your other income is below $150,000. The only way to really offset any significant income would be to use that short-term kind of rental loophole where you do the cost segregation on a short-term rental. If you materially participate in that short-term rental, then it becomes a business, and then any losses can be deducted against your other, W-2 or other business income that you have. So it could create a significant loss that, it works really well, say if you're married, right, and your wife, say her spouse has, say a $200,000 W-2 income, and you can generate, say, $100,000 loss on your short-term rental, then that goes straight off of that $200,000 W-2 income, and then you probably get a significant refund off of that.
So it works better with people with W-2s?
W-2 or other business income, or any other income outside of the real estate area. So if you have a lot of real estate income, then yes, you can use that cost segregation to offset the real estate income. But if you don't, say your real estate is breaking even, or, with depreciation and everything, a lot of times it just kind of breaks even or doesn't, or creates losses sometimes. So then if you just add losses to that, you can't really take any, it doesn't give you any advantage. But if you have other income outside of that, either business, W-2, or even investment income, if you have a lot of investment income, then yes, you can use the loss from that short-term rental if you qualify against those other sources of income.
Could you explain in the most simplest terms what cost segregation is?
Sure. So you're basically taking a property and dividing it up into its individual parts. So normally, for tax purposes, when you buy an investment property, you just divide it by either 27 and a half or 39 years, depending on if it's residential or commercial, and then take that over its life. So you get a relatively small amount each year, right? Depending on the size, price of the property. But when you do a cost segregation, you separate all the individual pieces of that. So the landscaping, the cabinets, all the little pieces, and it separates them out into their own categories. And then those smaller pieces can be deducted faster, so they have a shorter lifespan, so you can either depreciate them faster or use bonus depreciation against that. And like I was telling Alex, it's either, currently it's 60% for 2024. If you were to buy a property this year and do that cost segregation, you could bonus depreciate 60% of any asset that's 20-year life or less. But the Congress does have a bill in progress that, by the time he finishes all this, may have passed by that point, that would reinstate the 100% bonus depreciation. So you could deduct all of that, all of those pieces that are less than 20-year property or less, deduct that against your rental income. And if you meet that short-term rental qualification, then you could also take that against your other W-2 or business income.
Another question, could you accelerate that depreciation instead of waiting each year?
So that's what that bonus is, right? So that's what that 100% is. So you can, anything under 20 years, you can apply, or 20 years or with a life of 20 years or less, you can apply bonus depreciation to. And that is just expensing it currently this year. So, and like I said, if that 100% rule, the new law passes, then you could take all of it, say this year. Say you bought a property this year, do a cost seg this year. You could expense all of the portion that qualifies for the bonus depreciation in the current year. And so accelerate it right up front. And then the rest will just go along that 27 and a half or 39-year period.
So for example, one property that we're buying in Vegas, we're buying it subject to, and the owners requested us to refinance in 5 years.
Okay.
So would we be able to use cost segregation for that, or not necessarily, because we're only going to own it for 5 years?
No, yeah, it would work. So if you're going to own it and actually use it as an income-producing property, if you're just holding it as an investment, then the cost segregation probably wouldn't make much because you wouldn't be depreciating it against anything. But if you're going to rent it out and say use it as a short-term rental, then the cost segregation would definitely work.
It's going to be like a secondary home for us.
Oh, secondary home? Okay.
So whenever we fly into Vegas, we already have a place to stay, so no need to book a hotel or an Airbnb.
Then probably not, because you're not going to be using it as an income-producing property, which means that you wouldn't be able to deduct any of the expenses against it, which, then the cost seg would be, you could do it, but it wouldn't provide you any benefit.
Would the loophole be if we were to rent it to our own LLC and we're just paying some monthly rent to it?
If you didn't tell your accountant, maybe.
No.
You can't self-rent, So you can't rent to yourself.
We could rent it to our friends.
Yeah, you could, but and you can't use it yourself more than 14 days, the lesser of 14 days or 10% of the time you rent it. So if you only rented it out 10 days, then you couldn't use it yourself more than 1 day. Otherwise, you lose a lot of the benefits of the deductions.
Okay, well, that's good to know. That prevents us from doing something dumb in the future.
All right, well, thanks for coming, guys. And do you have any other questions?
I think that's it for now.
Well, if you found value in that episode, please make sure to like and share this with someone else who you think may have these questions. And of course, if you want to connect with Derek, where can they find you?
You can always email me or find me on Instagram at DT Fujikawa.
Awesome. And that's all going to be linked down below in the description. And so we will see you there. Thanks, Derek.
Thank you.